Hello, and this is Global Business Insights, where we look deeper at the headlines from a business perspective. The Organization of Petroleum Exporting Countries, OPEC, in its July report has reduced its forecast for global oil demand growth in 2024 by 135,000 barrels per day. It also cited weaker than expected data for the first half of the year and softer expectations for China as reasons for trimming its expectations. Oil prices, however, climbed up about 1.46% for Brent, close to $81 per barrel as demand concerns were overridden by a rising geopolitical risk premium. $2.43 billion or 1% had been wiped off the market value of Adani companies by the end of the trading day in India, which was a substantial recovery from earlier losses of more than $13 billion. Adani Group's stocks sank today after Hindenburg research accused India's chief market regulator of having conflicts of interest that prevented a thorough probe into fraud allegations against the conglomerate. Today, South Korean authorities met to discuss electric vehicle safety and whether to require car firms to disclose battery brands. This is as we see growing consumer concern after an EV-linked fire outbreak in an underground garage extensively damaged an apartment block. This week, we see again business showing an interest in the politics as social media platform X owner Elon Musk interviews Donald Trump later in the evening. This is as Kamala Harris continues to gain more traction in the polling. Fed Reserve Governor Michelle Bowman on Sunday said she saw upside risks for inflation and continued strength in the labor market, warning that the Fed may not be ready to cut rates in September. A former Bank of Japan board member has ruled out another rate hike this year. Makoto Sakurai said in an interview late Friday that the Bank of Japan won't be able to raise the policy rate again this year, given the market turmoil that followed its recent hike and the low likelihood of the nation's economy seeing a rapid recovery. The pay of FTSE 100 chief executives surged by £560,000 to an average of almost £5 million last year, rebounding to levels not seen since 2017. The figures come as UK executives push for higher payouts to compete with international rivals, particularly in the US, where company bosses are paid significantly more. And in Nigeria, on Friday, the Dangote oil refinery called on Nigeria's upstream oil regulator to force producers to abide by the Petroleum Industry Act that stipulates they supply local refineries. The 650,000 barrels per day capacity refinery has struggled to get sufficient supply from Nigeria, where vandalism and low investment continues to impede oil production. Welcome back. Saudi Arabia says it sees sales of low volumes of crude oil to the world's top importer, China, next month as prices were raised for September. The kingdom plans to export 43 million barrels of crude to China in September, down by about 3 million barrels from August's estimated 46 million barrels of shipments. According to the latest OPEC July report out today, the OPEC reference basket is up 1.5% month on month. World economic growth also forecast at 2.9% for 2024 and 2025, unchanged from last month's assessment. Following strong growth in second quarter 2024, US economic growth forecast for 2024 has been revised up to 2.4%, while the 2025 forecast remains unchanged at 1.9%. OPEC, however, cut its forecast for global oil demand growth in 2024 due to weaker than expected data for the first half of the year and softer expectations for China, and also trimmed its expectation for next year. The Organization of the Petroleum Exporting Countries report said world oil demand will rise by 2.11 million barrels per day in 2024, down from growth of 2.25 million barrels per day expected last month. The world oil demand growth forecast for 2024 therefore is revised down slightly by 135,000 barrels per day from the previous month's assessment. 2.11 million barrels per day of demand growth, the report says, is still well above the historical average of 1.4 million barrels per day seen prior to the COVID-19 pandemic. On supply, liquid supply from countries not participating in the Declaration of Cooperation is expected to be unchanged, growing by 1.2 million barrels per day in 2024. The non-DOC liquid supply growth forecast for 2025 is also unchanged at 1.1 million barrels per day. The demand for DOC crude in 2025 is revised down by 0.2 million barrels per day from the previous assessment to stand at 43.6 million barrels per day. This is, however, still around 0.6 million barrels per day higher than the estimate for 2024. According to the report published based on secondary sources, Nigeria's 2023 production was on average 1.314 million barrels per day and increased only marginally to 1.359 million barrels per day in May, 1.369 million barrels per day in June, and 1.386 million barrels per day in July. OPEC also sees transport fuel demand expected to remain solid due to healthy road and air mobility. Still, this is the first reduction as far as the demand growth is concerned in OPEC's 2024 forecast since July 2023. One notes that there is a wide difference between forecasters on the strength of oil demand growth in 2024, and that is due to differences over China and also more broadly over the pace of the world's transition to cleaner fuels. Notably, the International Energy Agency, which represents industrialized countries, sees much lower demand growth than OPEC of nice 70,000 barrels per day in 2024. That is a material difference of 1.14 million barrels per day below OPEC's latest projections. At the last OPEC Ministerial Monitoring Committee JMMC August 1 meeting, member countries said the gradual phase out of the voluntary reduction of oil production could be paused or reversed depending on prevailing market conditions. These countries had announced the extension of the voluntary reduction of oil production by 2.2 million barrels per day until the end of September 2024 and outlined plans for this reduction to be gradually phased out on a monthly basis until the end of September 2025. The JMMC also could convene additional meetings or request an OPEC and non-OPEC ministerial meeting if the need arises. In a statement issued on Friday, Dangote Refinery accused the Nigerian Upstream Petroleum Regulatory Commission (NUPRC) of not enforcing a provision in the Petroleum Act that requires crude oil producers to supply domestic refiners with a portion of their production, adding that international oil companies are not following the instructions of regulators. The NUPRC had said producers like NNPCL, that's the National Oil Company, had its own challenges, while others had pledged most of their production to oil traders and said forcing some to supply Dangote would violate their contracts. Last week, Monday, Fitch downgraded Dangote's national long-term risk rating to B from AA ratings, and the senior unsecured debt rating issued by Dangote Industries also downgraded from AA to B+, both also on rating watch negative. Lower ratings means higher costs of borrowing for Dangote, and the downgrade, according to Fitch, reflects significant deterioration in the group's liquidity position following lower than expected disposal proceeds. Operational and financial underperformance also affected by local currency devaluation and lack of contracted backup funding to repay its significant debt facilities maturing at the end of this month. Also, the lack of Dangote Industries audited accounts for 2023 is a corporate governance issue that Fitch is closely watching. The risk watch negative also reflects uncertainty related to the group's ability to refinance maturing debt. The inability of IOCs in Nigeria to fulfill regulators' directives to supply the Dangote industries means Dangote may be forced into more expensive options to source its crude. Dangote says the same Nigerian crude from international traders cost an extra $3 to $4 premium per barrel, which translates to like $3 to $4 million per cargo, and certainly worsens what Fitch already saw as a precarious working capital position. It's hard to see how governments, short of nationalizing IOCs, can force them to sell their crude in Naira or to direct them to sell to Dangote. Also, perhaps harder to comment on the impact of all this on working capital deficits without seeing Dangote's audited 2023 accounts, even as it makes sense for the federal government to do all that it can to support the successful operation of the refinery. Dangote, however, needs to be transparent, timely, professional, and rigorous with financial disclosures as it aims for listing in local and global stock exchanges. With all eyes on the refinery, it cannot afford any missteps in its reporting. The pact with NNPCL to supply crude is obviously challenged, especially as NNPC hopes to revive its own refineries, is pre-selling crude to finance borrowings, and beset with supply chain issues, including crude theft, all as investment in production is hurt by exit of IOCs and the perception of a higher risk and less attractive environment in the Nigerian oil and gas basin. Adani Group saw its stocks lower today after Hindenburg research accused the head of India's market regulator of conflicts of interest, which it alleged had prevented a thorough probe into the US-based short sellers' claims of manipulation and fraud at the conglomerate. In a report, Hindenburg alleged that Madhabi Puri Bush, that's the chairperson of the Securities and Exchange Board of India, and her husband Dhaval Buk, had invested in offshore entities that were allegedly part of a fund structure in which Vinod Adani, that's the brother of billionaire Gautam Adani, also had investments. Bush denied the allegations. Despite the denial, shares of Adani Enterprises Limited, the group's flagship, fell as much as 5.5% in early Mumbai trading today. Adani Energy Solutions Limited plunged as much as 17% before recovering some of the losses. All of the conglomerate's 10 stocks traded lower. Analysts are concerned about the veracity of claims, resulting in short-term volatility as allegations further erode investor trust and could deter foreign capital and lead to a call for more stringent ethical rules. In the UK, the number of companies on the FTSE 100 paying their bosses more than £10 billion rose from 4 in 2022 to 9 in 2023. AstraZeneca Chief Executive Sir Pascal Soriot remains the highest paid FTSE boss with total pay of £16.9 million, up from £15.1 million a year earlier. Higher pay tend to be a reflection of the wider pay market and shortage of C-suite talent, and to attract world-class talent, pay incomes, of course, will have to rise. We also expect to see more of bonuses and share awards linked to performance. Critics of higher compensation argue that median FTSE 100 CEO is now paid 120 times the median full-time British worker, which could also be a problem in a new Labour government that has pledged to make it easier for unions to gain statutory recognition and improve their rights to access workplaces to organize and recruit. European stocks traded mostly lower with focus on US and UK inflation data. US stocks struggled with volatility, having previously opened the session in the green, up and down, stabilizing slightly lower for a while, at best mixed. Nasdaq, as we speak, is slightly up, but the other two indices, Dow and S&P, still in negative territory. That was after almost completely reversing the turbulent route of last week. And this is also as investors are bracing up for key inflation data later in the week. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Please send your comments. Again, thank you so very much for watching. Bye-bye.